Every minute the financial market is open, you are watching a tug-of-war. Buyers push prices up, while sellers drag them back down. But occasionally, the market hits a sudden point of equilibrium. It's a stalemate known as a doji. Look at how a standard candlestick compresses. A doji forms when a trading session's opening and closing prices are the same. The rectangular body shrinks until it disappears, leaving only a horizontal line. The market reached a tie. Neither buyers nor sellers could hold ground before the closing bell rang. Identifying this moment of stillness allows a trader to spot where the current momentum is stalling, potentially signaling a shift in the trend. You cannot just hunt for shapes. On this chart, a doji forms mid-trend. Here, the signal is invalid. To function, it must form at an extreme. We look for these patterns at the peaks and valleys of 25 days of data, or an intraday high or low. Context defines the trade. Acting on a doji in the middle of a price range is a common error, while identifying them at the extremes reveals where a trend is likely to break. At the peak of this market climb, we see the Gravestone doji. It is marked by a long upper shadow and a flat bottom line. This shape reflects the market psychology of the session. Buyers pushed the price upward, but by the close, sellers moved the price back to its starting point, indicating buyer exhaustion. A trader waits for the price to drop below the low of the candlestick that appeared just before the doji. That crossing is the entry trigger. Risk management is set by placing a stop-loss order just above the highest point of the doji's upper shadow. The Gravestone provides a specific structure for the trade, identifying both the entry point and the level where the setup is no longer valid. At the bottom of this market valley, we find the Dragonfly doji. It mirrors the Gravestone, featuring a long lower shadow and a flat top line. Here, sellers drove the price down, but buyers rejected the move. They forced the price back up to the opening level before the session ended. The entry strategy requires waiting for the price to break above the high of the candle preceding the doji. The stop-loss is placed beneath the lowest point of the Dragonfly's tail to protect the capital. Trading the Dragonfly is about following a confirmed shift in momentum, rather than trying to guess the exact bottom. The long-legged doji has symmetrical upper and lower shadows, with the open and close sitting in the center. This symmetry indicates uncertainty. Often, the market will move sideways within a limited range following this pattern. The four-price doji appears as a simple minus sign. This occurs when the open, high, low, and close are the same, indicating the price did not move during the session. These variations do not offer a clear direction. Recognizing them helps a trader avoid entering the market when a trend is not present. After entering a trade, the trader's focus shifts to actively managing the open position as the new trend develops. The strategy described by the pattern is to remain in the trade and allow the trend to progress. This chart shows a trade following an upward trend. The position is held until a new, distinct reversal signal appears, which marks the exit. The doji functions as a clear framework for applying strict risk management and technical rules to a moving market. Mastering these patterns provides the structure to execute a trade and the patience to wait for a trend to complete its course.